Hello, everyone. My name is Federico Tozzi. I'm the Executive Director of the Italy America Chamber of Commerce. Thank you for joining us on this webinar. It is a pleasure to introduce my personal friend and also a great member of the IACC, Carlo Mantica. He's a financial advisor. And I'm pretty sure that the topic of this webinar is very interesting. And I'm going to leave the floor to him. And thank you very much for joining us.
Great. Thank you, Federico. And thank you to the Italy America Chamber of Commerce of New York to allow me to start the conversation about personal wealth management. I do these seminars often in different settings, both online and in person, and also in the company's context for employees' wellness and financial wellness. Tax favored investing is often a very sought after topic. So I'll dive right into the presentation. At the end of the presentation, you will be allowed to have a individual personal educational session. The chamber will share a link to book a time in my calendar, and we can deep dive into personal questions. We'll also have sometimes for individual questions right at the end of the presentation, but we can go more in depth following the presentation for a personal educational session. So first, I would like to express the fact that these viewpoints are my viewpoints, and Money Management Educator is educational-only division of New York Life. It's a registered investment advisor, Eagle Strategies, and a broker-dealer, NYLIFE Securities. So none of the opinions are the Chamber of Commerce, and want to make sure that they're disclosed from liability of what I may say. So first, a quick thing about myself, as many of you know me already, I'm from Milano originally. I graduated from Bocconi University. I worked a few years in Europe and then moved to New York to pursue a master in business administration from New York University Stern School of Business. Many of you know me because I co-founded the alumni of Bocconi in America, as well as an organization called NOVA, and we have an annual reunion and Congress, which happens next week at Columbia University. So if you do have an MBA, please reach out. I'm also a financial services certified professional, that's FSCP, and I'm a retirement income certified professional. So often I advise clients on retirement planning and retirement income planning, and also between the US and Europe. So we'll start with the topic today, which is in three different sections. We'll address first the current state of change. Then we move on to an example of pre-tax versus after-tax investing. And lastly, I will leave you with the macro balance strategy. So we'll dive right into the state of change. And the first is a slide on tax brackets. Like in Italy, in the US, we have a progressive tax system. At the federal level, there are 7 tax brackets, with 37% being the highest tax bracket. So I always try to explain that your marginal tax rate is the highest dollar of tax that you pay. So if you file tax jointly with your spouse and you make $100,000 a year, you're gonna be in the 22% marginal tax rate, but your effective is going to be a blend, because the first, if you look on the right side, under the joint column, the first 23,000 and change will be taxed at 10%. Anything above that, up to 96,000, will be taxed at 12%. And the last few dollars to get to $100,000 will be taxed at 22%. This is a little bit how the tax bracket in our progressive tax system work. Although the point of the slide is that, as you may notice, there is a difference between 2024 and 2025. And so tax bracket do change every year often. on the income tax, right? So this is what you file federally. Of course, for those of you that are lucky enough to live in New York, they also have state of New York asking for state income tax. Not all states have a state income tax. Then you have something called standard deduction. So I typically say, again, you have a standard deduction. If you file jointly, the federal government allows you to deduct $30,000, no question asked. And that also has changed and changes over the years. That, of course, is different than the itemized deductions that you may do if you feel that you can deduct more than $30,000 as a joint filer or $15,000 as a single filer. There is also something that's expiring, the $500 tax credit for non-child dependents, for elderly parents, and different taxation on investments. So the government, I guess, it wants to give a little more incentive for people to invest. For example, if you invest in the stock market, very popular this year, we're achieving great returns. And so if you open an investment account, which is something I do for a lot of you, with any gain over 12 months. So if you buy a stock, let's say of NVIDIA or Microsoft, and we sell it after 12 months, we then have a favored taxation. No longer the shorter capital gain, which is taxed at the ordinary income tax rates that we saw at the beginning, but we fall into a different taxation, which is the long-term capital gain. Next is popular quick little trivia. I'll skip this because we are in a seminar setting, so I can't hear you. But so just that the Madison Square Garden is exempt from property taxes as long as the Knicks and the Rangers keep playing in their home games there. Capital gains. So it's a tax favor taxation. So it's an incentive of investing into stock market, for example, right? In years or little no income, it may become a good time to take those positions and pay capital gains. So there is a lot of strategies that change. I have a lot of clients, sometimes they move back to Italy. That's maybe a good year to take those positions where you have a capital gain. You are going to be in a lower tax bracket because maybe it's a year in transition, you have less income, and maybe it's a good time to pay the taxes, maybe at the lower tax rate or even 0%, right? So that's also a good strategy when you have a year where you are in transition, where you're expecting less income than your normal years. And these apply also for something called Roth conversions. If you have pre-tax money into retirement account, it's also a good time to take advantage of the fact that you have a lower tax income year. There's some exclusion, for example, for primary residences, 2 out of 5 year rule. If you own a house and you're filing jointly, you can exempt up to 500,000. I won't get too much into the details. I always advise to get tax advice from a CPA. There are plenty of CPAs that are members of the chamber. My role is to help with the tax planning part. Again, when we looked at the IRA or 401k contribution, you are allowed to contribute to an IRA. There are some limitation based on income if you do a traditional IRA or a Roth IRA. And then those amounts change also over, in 2025, for example, the 401k allows you to have a $23,500 as a maximum contribution. That's $500 more than the last year. That doesn't include the match that you may get from the company, right? That's on top. Also, if you're over 50, you're allowed for an additional catch-up contribution of $7,500. And there is something new that is changing this year. If you have 60 years or more to 63, instead of 7,500, you can go up to 11,250 on top of the 23,500 of the base contribution. There are plenty of additional strategy. That's what I do for a living. If you have any question about retirement accounts, please schedule a personal educational session through my Calendly that you will find at the end of the presentation, and the chamber, Martha, will share with you. Does anybody know what's the first year you can withdraw from a 401k without a 10% penalty? That's age 59 and a half in the US, right? So if you're below 59 and a half and you're contributing to an IRA or 401k or 403b, a retirement account with tax incentives, you should really put the money in there for the long term for your retirement. As a general rule, since we're speaking about personal wealth management, I try to teach the 50-30-20 rule. So 50-30-20 means that if you earn $100, is a good rule of thumb, you should spend 50 cents or $50 on necessities. So, having a house, having some food on the table, some pasta and maybe a glass of wine. 30% on discretionary spending, nice travel, nice restaurants and movies and things like that. And then 20% save it for the future. So that 20% could be allocated in part to a retirement account, which is an excellent vehicle to put money away for retirement. Many people come from Italy. They're members of the chambers, and they're accustomed to a very different system. In Italy, we have free healthcare. We have a safety net around us when it comes to a lot of the government program, which do not exist in the US. There is something called Social Security, which is like the IMSS in Italy in a certain way, that you earn the right to take if you contribute for 40 quarters, that's 10 years, not necessarily consecutively. But that's never been intended to be the only source of income in retirement, right? Unfortunately, it is for the majority of Americans, and that's because we fail to plan. So if you plan accordingly and you put money away, in addition, obviously, from your mandated payroll tax deduction that goes to Social Security, you're probably going to be in a good shape. Ideally, you want to get to a situation where you have about 20 times your income saved up in some sort of assets, whether it's a house, whether it's a retirement account, a brokerage account, a cash value life insurance saving account. And that is a good rule of thumb of having enough wealth so that you can possibly retire. But certainly the retirement account should be left there untouched until 59 years and a half. There's some exception which I really discourage to think about as a primary venue to get money, and it's really kind of real exceptions. So there is something called the Rule 20 of 55. Hardship withdrawal requires a lot of paperwork, that substantially equal periodic payment, which is typically suitable for people that have accumulated a lot of wealth earlier than 55 years old, and they do want to retire, but they have significant amount in their retirement account. I won't go into the details, so feel free to schedule a personal educational session and consult with your tax advisor, tax preparer. Other things like if you have a baby, you buy your first home, of course, you have disability and high medical expenses. There are very limited amounts that become taken out. Once you reach age 73, and if you did contribute to your 401k or IRA in a pre-tax form, not the Roth, but if you did a pre-tax contribution, then the government wants their share because they gave you a pass on taxation when you contributed. They let you invest over time without paying any tax. And so that means that the money was invested tax deferred. And when you reach age 70, and you had the opportunity to take money out from age 59 and a half, and when you reach age 73, they force you to take what's called a required minimum distribution, which is really a formula based on age, and it's an amount of money that you have to take out from your tax qualified accounts. And if you do not do that, there is 25% tax penalty on the amounts that are not distributed. So you definitely want at that point withdraw the RMD at least and pay the taxes on that distribution. So the way it works is when you withdraw from, let's say, a 401k, in that particular, in the future, that amount that you withdraw in that year is going to be added as taxable income and the ordinary tax income level. There are few exceptions to the RMD. I always suggest there are plenty of solutions that people are not aware of when it comes to pre-retirement and retirement, especially if you're planning to move back to Italy. Please reach out. I'm happy to share a lot of knowledge about those. These are some example of ways to partially avoid the RMDs. I won't go into that. Again, the point of that slide and the slide so far is that these things change. So also, many people, as you know, in the tri-state area move to Florida or one of these states. That is, of 2024, there were 7 states, Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming, that had no state income tax. So it's always a good strategy to have a contribution pre-tax in New York and save, or in state income tax, and then move to Florida or Tennessee and take the money out, and there is no state income tax, right? Now, when we finish with that section, which really highlights the fact there are many different taxes. We haven't even talked about gift tax. We haven't even talked about estate income tax, tassa di successione. And all those taxes change over time, right? Now, let's do an example of pre-tax and after-tax investing. And let's pick 2 people, Robert and Roberta. And let's assume they both contribute $4,000 to their retirement account, right? Let's say their 401k, and or Roth 401k or Roth IRA or IRAs. So Robert pursues the strategy to contribute pre-tax. So he will pay 0 tax at the year he contributes. So let's assume tax is 25%. Let's keep it simple. So at the end of the first day, when he contributes, his account will be $4,000. He contributed $4,000. He's not paying any tax. He will have $4,000. Well, Roberta decides to contribute after tax, Roth, let's say, right? So she will have to pay 25% tax. Her account balance will be $3,000. Well, let's fast forward to day 2. If, let's say, there is no penalty to take money out, if Robert decides to take the money out, well, he has to pay the tax at 25%. So his account balance will be $3,000. If Roberta decides to do the same thing, take the money out, she had to pay no taxes because she contributed Roth. And so she will also have $3,000. So at the end of day 2, the same outcome, right, on both strategies. But let's fast forward to retirement, right? Let's say he contributed over time $400,000, or think of with the growth, he got to $400,000, and let's assume that she contributed and she has $300,000 at that point, right? So if they liquidated, well, let's assume the tax rate is still 25%. He has to pay $100,000 in tax, so his account balance will be $300,000. Roberta has contributed Roth, no tax to be paid. She also will have $300,000. So again, no difference in the 2 strategies, right? Between pre-tax or Roth. Now, let's say they take money out instead of all at the same time. they take maybe 10% every year. So out of the 400,000 and the 300,000, they take 40,000 and 30,000 a year. Well, they have to pay taxes if you contribute pre-tax. So Robert will have a cash flow of 30,000. And guess what? Roberta paid the taxes up front, so she will also have $30,000 in her annual cash flow. Now, what happens if the taxes are lower? Let's say they move to Florida and there is no state income tax. Or let's assume for a second that the government is going to say, we're going to lower your taxes. Unlikely, but possible. Well, Robert, in that case, contributed, didn't pay the taxes at 25%, and he's going to pay the taxes 15%, right? So hypothetically, is in a lower tax bracket in retirement. But so his strategy is a winning strategy in that case. Down, right? But let's say taxes go up. Well, in that case, Roberta still with $30,000 is better off because Robert will have to pay 35% in tax that has gone up, right? The tax bracket. And so he's going to be left only with 26,000. So the point of the slide is that it really depends on what taxation will be in the future, right? So we don't know where taxation will be in the future. I'll skip the next page because it's kind of repetitive of this. And we'll go to the last section. Because I do want to, so we introduced the macro balance strategy. So before we do that, I want to briefly introduce our framework that we use to help and guide clients when it comes to personal financial wellness and personal wealth management. So think about that you are now in the US and you have to build your own financial life. You can't just survive based on the family around you and based on the government around you. You better think about building your house, your financial house, as soon as you are here or as soon as you start working. So where do you start to build a house? Well, you start by building the foundation. So what are the foundation of a financial house? The foundation are protection solutions. So I urge everyone to think about of a growth in their wealth that is powered by protection, because life comes at you where you would not expect it, but it will come at you sooner or later. And that means having in place protection in case there are catastrophic event that may derail your financial life, like big medical expenses or becoming disabled and not being able to work and earn an income for you and your family, or early death. So not being able to generate the income for your family. So in all those cases, there are solutions that you can put in place when there are these big catastrophic events. They're very infrequent, but they do happen. They will protect your family financial wealth. They're typically insurance solutions, but there is a lot legal solutions. So I always recommend to talk to your financial advisor about, of course, medical insurance coverage, disability coverage, especially the long-term disability, not just what's mandated in New York State, which is short-term disability and workers' comp, which is great to have, but it's not going to help in the long term. Life insurance from protection, so term life insurance is typically a great solution for that, as well as solutions like having a will or a living trust that you should consult with a trust and estate attorney. It's a state by state, so it really depends on where you live. But you should have a way to set in place legal documents and trusts. They're very simple, when you're just with the purpose of transferring your assets to whoever you want in an orderly fashion and not going through a lengthy and costly process called probate. Making sure that annually, every year, you check all your accounts, your bank account, your life insurance, your investment accounts, make sure your beneficiary information is up to date. Make sure you have secondary beneficiary. Let's say you have a spouse, something happens to both of you. You want to make sure that the money goes, or the assets go, your house goes titled properly, so it goes to the people that you do want to go to. So very, very important thing to have. Another thing that oftentimes I have a son who's 19. So, when you're 19 for HIPAA, no medical information can be shared. So making sure you have medical power of attorney from your child that is now over 18 to you as a parent. So you make sure you can access medical information. Likewise, for them to have access to your medical information, God forbid something was to happen. So very important planning tools. They're basic in tools, but oftentimes people don't think about it. And let me tell you, as you can see, I have a NYLIFE affiliation. Everybody is more than welcome to join me and see the view from my office at the One World Trade Center. And it's painful. It's painful when you have clients where NYLIFE has to pay out a claim for a death to an ex-spouse because the person forgot to update the spouse as a beneficiary in their life insurance policy. But it is what it is. So making sure that you have the right protection in place. Preservation, that's the ceiling on top. Again, there are plenty of solutions, strategies in the US. And of course, if you move back to Italy or another country, to preserve your money, whether it's a safe withdrawal rate, understanding how much money do you need to be safely retired, how should you change your investment strategies as you're approaching retirement or you're in retirement, what are the big costs to plan for in retirement, and things of that nature, all the way to setting up trust and ways to transfer to charitable causes, as well as build intergenerational trust. Definitely an area I'm passionate about, very important. But let's deep dive on the center. Right, we divide the accumulation phase of your life when you earn your money into 4 sections. So the accumulation and saving and investing, like you said, a good rule of thumb: $20 of every $100 you make, you should accumulate and invest it. Now, we have a 6-step strategy called the macro balance asset strategy to determine what's your most tax favored and what's the most balanced approach. One is chapters about risk diversification. The second is tax diversification. We'll deep dive on the pre-tax. We'll look at how to build a tax-free base and understand the above-the-line tools and get into what's your custom target mix. So I'll skip this and we go to the risk diversification. So that's like the first floor and the second floor of your house. The first floor is the stable assets, and the variable assets are on the second floor. What are those? Well, the variable asset, think of it as stock. The alternative investments into hedge funds. We offer crypto. We offer private equity investments, private credit investment, certain private real estate deals. The real assets are typically bonds, cash, your saving account, a CD, or fixed annuity, or guaranteed income annuity. Those have a lower return, but tend to be more stable. So you evaluate the two with primarily 2 metrics, not only, but primarily 2 metrics: is what's the return? What percentage am I getting on my investment? Is it 4% or 22%, right? And on the flip side, you have to look at what's the variability, the beta of the investment, right? So if you buy a growth fund that is full of tech stocks, let's say, well, they have probably a higher return, but a much higher volatility than your saving account, right? Which is very stable, or a fixed income for that matter, or whole life insurance. So generally speaking, if you're young and you're starting off in your accumulation year, well, you want to be probably more towards the variable. But as you grow older, your allocation, your custom mix should maybe move a little bit more towards the stable, right? So you have less variability in your wealth because you're actually withdrawing money at that point, right? Tax diversification is the center of the presentation of today. And so we really divide the house in two areas. The pre-tax, which include money that you invest in tax deductible, like a 401k, 403b for some of you that work for hospital or non-for-profit, deductible IRA, deferred compensation plan. Some people that may have a non-qualified deferred compensation plan from their firm. Some of the Italian companies here, they do have those. Pension plan, very infrequent. Those are old school pension. But if you work as a teacher, for example, or as a firefighter or a New York police officer, you may have those. Those are typically pre-tax. And then the right side is the after-tax money, like the Roth IRA or the Roth 401k. Your deposit account in the bank, checking and saving account, cash value life insurance, whole life, variable universal life, your brokerage account, your investment account, right? Those are after tax, right? So you put money in, there is no deduction. So tax diversification is really now changed over times. In the 70s, late 70s, early 80s, when the government legislated and created the tax code to include the 401k section, well, tax bracket, we had a lot more than the 7 we have today, right? The highest was 70%. Taxes were high, many brackets, right? The highest, a lot of people paid over 50% income tax, right? So the case for contributed pre-tax had a big impact back then, especially if you were a manager, right? Or doing well, contributing and accumulating. Today, as we saw at the beginning, we only have 7 brackets. The highest is 37%. The average is 24%. Most people pay in that range. So the case for contributing pre-tax and defer is not as strong as it used to be. So the balance is a more reasonable approach. So we advise to create a more balanced approach between income from pre-tax as you get to retirement and income from after tax, right? So, one-sided and non-balanced approach will have you contribute everything pre-tax. By the way, keep in mind that if your company gives you a match on your 401k, that's probably going to be pre-tax only, right? But you can probably choose between pre-tax and after-tax or Roth with your contribution. If it's not possible, let me know. I work with the other companies to update the plans and making sure that's possible, including in-plan Roth conversion. So a more balanced approach would be to maybe be 50-50 or a different combination depending on what else you have. This refers, for example, to the 401k or the IRA contribution. But we definitely recommend a more balanced approach between pre-tax contribution and Roth contribution. Or different vehicles, both below the line or more stable fund on the pre-tax, as well as the above the line. The above the line is typically where you want to be for most of your assets as you are contributing in your earlier year of your career, because it allows you to outpace inflation. Typically, they have higher returns. It's not uncommon with a lot of my clients in a year like this, where a situation where we have several funds, there are well above 10% average return in the last 10, 15 years, close to 20% or so, or even more. Obviously with a lot of variability, right? We saw that in April when the tariffs were announced. We saw that last week where everybody was starting to get worried about the shutdown. Still is. We haven't gone through that yet, but seems likely we're going to get over that. And Of course, if you work for a company that offers you a match, you should take the free money and contribute as much as you can to get the full amount of the free match. Now, the after tax, it's important as you get older in life, or if you approach the time to purchase, to retire and have a pension. And this applies not just your retirement planning, it applies to any big purchase you may have in life. For example, if you're saving for college, I have plenty of clients where we do college saving planning. If clients have children, of course, and they're planning to stay in the US, or we can do college saving planning a different way if kids are moving back to Europe. As well as a lot of my clients ask me to buy, they want to buy a house, they want to purchase a house. So you do want to build a tax-free base because it gives you safety, it gives you liquidity and tax advantage. And you can withdraw and not pay penalties, not pay, and no risk of the money declining when you need it, right? So municipal bonds are a great vehicle. Cash value life insurance is an excellent vehicle because it acts like a Roth account. There is a fixed or variable, so it can be both on the first floor and the second floor. And then, of course, Roth IRA, Roth 401k can be used and invested in a more safe way. And a lot of people come to me because they accumulated money throughout their life. They're over 50 or maybe even over 60, and they are defaulted into something called target date retirement fund, which is a balanced fund between fixed and variable investments that as you approach retirement becomes a little bit more safe. So it goes from the top floor to the bottom floor, but there are plenty of additional solutions that guarantee your bottom and will let you make decent returns on the upside in the tune of 4-10% with no risk of the downside. And the 4% tax-free is equal to a 6% return after tax, which is not too bad for somebody that is planning to use the money in the near term. So the bottom line is things like we said, the stock market, real estate. A lot of people think real estate is a safe investment, right? Well, not necessarily, right? Same thing with business venture, paper assets. A lot of your business owners, it can fluctuate in value. There is a lot of factors that can impact. So a funnel approach is what typically happens as you approach retirement. So you go from above the line to below the line, and you should really evaluate yearly at least your allocation between the different sides of the house and see if it still fits your risk profile, your objectives. And like I said, it can be for any big purchase. Of course, it can be to build your pension and your retirement, but it could be for college. It could be for child getting married and having children, and or it can be for a big purchase like a house or like a retirement house. So the last part of this presentation is that this is a generic. What I wanted to convey is that taxation changes over time. We need to be aware of the impact of taxation. We need to try as much as we can to move money from non-tax favor accounts, like your saving account or your regular brokerage account, into tax-favored accounts, like a Roth account, like a cash value life insurance, like a health saving account, HSA, like a 5 to 9 college saving plan, like a universal life accumulation policy for children. So there are plenty of tax favor accounts out there. So that allows you to grow money tax favor and tax free. And you should have an assessment of your customer target mix. We have enjoyed the last 3 years of tremendous growth of the stock market, but we all know that at some point the market will go down, which is irrelevant if we're not withdrawing. I was just meeting with the CPA before our presentation, and he told me that Friday he took money out of the market and is thinking about if he should invest again in the market next week or maybe wait to January. Well, what we know from history and statistics and analysis that if you miss the 5 best days of the market, which is typically when the market bottoms out, you're going to have a significant impact on the portfolio performance. So do not get out of the market when the market goes down, right? Of course, if you're planning to retire, you're going to start to withdraw, you have to plan ahead, right? So your custom mix may change over time. It's important to set it and review it at least once a year. So that includes understanding what your objectives are for that particular pool of money or all of your portfolio. Part of what I do is I do a comprehensive financial planning with a great software called eMoney. So we can be very analytical, very specific, or we can do quick and dirty calculations and determine based on your objective how you should invest your money. Any financial advisor should be able to work with you to do that. In the time horizon you're going to need that money, and what's your risk tolerance, right? So I hope you enjoyed the presentation so far. I've asked the chamber to share an evaluation form that will allow you to also put your contact information. And if you want, we'll set up a personal educational session. I use, as you can see, Zoom, or you can come in person. We have a nice coffee shop on the 64th floor. Come to my office, and we'll review your personal questions and education sessions if you want more details of the different parts of the financial house. I hope you had the value coming out of this seminar. Now, if you do have, we have a few more minutes left. So if people have any questions, please go ahead.
Yeah, so please, should you have any question, you can submit them via the question box, and so that Carlo can address them.
And also, if you would like to see any more specific topics, I'm happy to do more in-depth on specific topics in the new year. And I always say the most important thing you can do with your financial life is plan ahead. Most people don't plan to fail their financial life, but they do fail to plan. I think we may have a question. Okay. Thank you, Fabrizio. Okay, there is a question about having a session for non-residents. Yeah, I certainly have a lot of clients that are non-residents. So we can certainly do a personal education session for non-residents. There are a lot of things we cannot do if you're not resident, but depending on your particular situation, there are a lot of information that can be shared about both the U.S. personal wealth management, as well as if you are living abroad, but you may have business interest in the US. There are certainly great solutions that we can put in place. Oftentimes, I work with your attorney or accountant and to review any specific questions. I also want to clarify, I do not work with clients that live overseas for the wealth management side. But as long as you have interest and question with regards to the US or wealth management between different countries, yes, happy to help. And I deal constantly with the obviously clients that are part of the chambers, oftentimes have relationship with Italy and the US. And it certainly is a good strategy to work in the US and end up retiring in Italy. The cost of living is a lot cheaper, and the quality of the food and the wine is certainly better in most cases. Also, if you have, questions about coming to America and locate your business in different states, the tax favor investing, of course, changes state by state, because in the US we have a 2 or 3 tier taxation. So you get taxed at the federal level, regardless of where you are. But each state and possibly even city like New York City or county may have their own tax that impacts income tax. It also impacts estate tax, sometimes tasso di successione. It impacts medical insurance cost a lot, many other things. So oftentimes is a question that I get is how to locate your interest in the US. All right, Marta, I think we have.
Yeah, I'm not sure if anyone has any other question, but we will be sending a follow-up email with the summary of today's session and the recording of the webinar with Carlos' Calendly link, as he said. So if you would like to schedule a session with him, you can go ahead and do it via email. I think we have another question from Fabrizio that says, is there any age you suggest for the balance between stock investment and more conservative options?
That's a great question, Fabrizio. Typically, think of it this way. We call it sequence of return. That's the biggest risk people have with their money in retirement, which is really the concept that if you invest in the stock market, and the stock market, as you know, some years goes up, some years goes down, right? And if you are between, let's say, 25 and 55, you're working, the money you're putting away, let's say in your 401k or your retirement account is dedicated for your retirement, and you're not really touching that money or plan to touch their money, right? Because you're not planning to retire before 55, let's say. So the sequence of the returns of the stock market, it's completely irrelevant. So it's irrelevant how you switch the years. So if you start with 100, let's say 100, some years up, some years down, and you invert those numbers of growth and decline, you end up in the same place. When it matters is when you start to withdraw. So typically in retirement, the sequence of return of the market really does matter. If you have few bad years with market decline in the first few years of retirement, and you are withdrawing because you need to get an income out of your retirement on top of your Social Security, let's say, that withdrawal in a declining market will significantly impact your portfolio and your wealth throughout the entire retirement phase of your life. So I normally recommend to think about strategies for retirement income planning about 5 to 10 years away from retirement, right? The same way of obviously, if you're planning for college planning, you should start college planning soon as you have a baby, or even before you have a baby. But 5 years away from college, you should really evaluate the investment, right? And that kind of risk balance. Same thing if you're planning to buy a house. Obviously, I get clients that come all sorts of ways. Some people tells me, I want to buy $1 million house and start saving, and they want to buy next year, right? We can try miracles and do something that is better than nothing, but you do want to plan ahead. So I guess that's really depends on your time horizon to answer your question. And so typically for retirement income planning, that is somewhere between 50 and 55. There are also solutions to learn about, whether it's long-term care planning, whether it's income annuities, and there are plenty of strategies. I won't go into too much details. Please set up an individual educational question. And it's also based on your personal risk profile, right? So there is nothing wrong with a 4-5% growth guaranteed, even if you are 40 years old, right? And if you don't understand the stock market, you can't stomach the up and downs, there's nothing wrong with that. Certainly, there is better option than the saving account. So if you have a significant amount of money, or at least more than 3 months saved up in your saving account, 3 months of your expenses saved up in the saving account, allow me the opportunity to show some additional options. And that applies to corporations too. If there is any CFO, we do plenty of cash on the balance sheet solutions for companies too. Any other question? All right.
Okay, for now, I don't think we have any other question in the box.
Okay, so I hope to see everyone at the next chamber event.
Okay, so we will send a follow-up email, and I'd like to thank Carlo for this insightful session. And of course, we look forward to having you join us for our next webinar. Okay, thank you. Thank you, everyone.
Thank you.